So, welcome to the webinar. This webinar is brought to you by Taxman Publications. So, yes, we'll start. So, a quick intro about Taxman. Taxman is a leading publisher on tax and corporate laws in the country. We also maintain the largest and most accurate database on income tax, ILT, GST, company law, etc. Our products include books, journals, online and offline research platforms, tools for TDS compliances, etc. We also developed the national website of the income tax department. We also maintain with our technology and editorial support. Right. So, what are we here to discuss today?
Hello.
Quick intro about the topic. So, India is going through a tough time due to COVID-19 pandemic. Employees are facing liquidity problems, and employees are encountering salary cuts, deferment of salary, and in extreme situations, loss of job also. In this webinar, our team will help you to understand certain tax issues that may arise in this situation and how to get some relief under the new tax regime. We have with us CA Dipen Mittal and CA Tarun Kumar. CA Dipen is a part of our income tax team of R&D team of Taxman. He has been working with Taxman Group company for more than 5 years now. CA Tarun is a practicing chartered accountant. He has been associated with the editorial team for Taxman Publications for more than 2 years. He has more than 3 years experience in income tax matters with specialization in taxation of startups and charitable and religious trust. So, quick tips for attendees: your mic will always be on mute. Your post your questions on the chat box on the right hand side. We are entire R&D team supporting you through the chats. After the session, you'll also get a copy of this presentation for your future reference. You can download this whole presentation. Right. Over to you, Dipen and Tarun. Please, Dipen, please go ahead and walk us through the tax regime on under for salary class.
Okay, thanks, Avinay. Uh, Good afternoon, friends. Myself, CA Dipin Mittal, and I am with my colleague CA Tarun Kumar. We welcome you all to today's webinar on impact of COVID-19 and new tax regime on employees. As you all know, this pandemic COVID-19 has forced not only India but almost every country of the world uh, to impose lockdown to safeguard the life of their citizens from this virus. In India, the lockdown was first announced by our Prime Minister on 24th March, and it is still not lifted considering the rising cases of coronavirus. Though certain relaxations have been provided under Lockdown 4.0, as we know, during this period of lockdown, businesses were shut, which results in detrimental impact on business operations of many entities in India as well as globally. For instance, company like Maruti Suzuki has not been able to sell a single car in India in the month of April 2020. To overcome this crisis, many companies have implemented stringent measures, which includes job reductions, salary cuts, and deferment of salary. So, in this webinar, under first part of today's webinar, Tarun, my colleague, will be discussing about all such measures and tax implications thereof in the hands of employees. Under part two of the webinar is on section 115 BAC, which is inserted by Finance Act 2020 under Income Tax Act. Section 115 BAC basically provides for a new tax regime for individuals and HUF. So I will discuss about that section in detail in second half of this webinar. So friends, this is the agenda of today's webinar. And now I am handing over to Tarun for part one. Tarun, please start.
Thank you, Savini and Dipen, and good afternoon, everyone. I hope you all are doing safe and taking good care during this tough time. Friends, the COVID-19 pandemic has stalled the economic activity at an unprecedented scale. It has raised the specter of job losses, and it is very unfortunate that many companies are firing their employees. Further, some companies are opting for reducing their cost by making pay cuts or deferring the salary of their employees. I have also seen that many employers are exploring the issuance of non-cash compensations like ESOPs and long-term incentive plans to handle the situation of immediate cash crunch. Our finance minister has already reduced the rates for TDS and TCS by 25% on specified payments, but the TDS rate on salary has not been reduced. TDS on salary is paid at an average rate so that employees do not pay taxes at the time of filing their income tax return. Thus, it may be concluded that TDS rate on salary have not been reduced so as to prevent the salaried people from facing heavy tax burden at the year end. Friends, today I'll be covering the impact of COVID-19 on salaried class from income tax perspective. I have seen that many employees are finding it difficult to understand how they will get impacted by this crisis going ahead and how to minimize its impact on their take-home pay. So I'll be discussing issues involved in these 5 key points. Tax treatment in case of pay cuts, tax treatment in case of deferment of salary, tax treatment of allowances due to lockdown situation, withdrawal from savings scheme, changes in the rules for contribution to Provident Fund as announced in Pradhan Mantri Garib Kalyan Yojana and Atmanirbhar Bharat stimulus package by the Finance Minister. Friends, before I jump to the issue, let's just understand the taxability of salary and applicability of TDS thereon. The income tax provides that salary is taxable on due or receipt basis, whichever happens earlier. Taxable salary shall include taxable allowances, perquisites, retirement benefits, and profits in lieu of salary. Certain deductions are also allowed from salary income. TDS on salary is deducted under section 192 at the time of payment of salary. So every person responsible for paying any income chargeable under the head salaries is required to deduct taxes therefrom under section 192. So the estimated tax liability of the employee is recovered from his monthly salary income over the financial year, and this tax is deducted at the time of payment of salary. Now let's take up the first issue, that is tax implication in the hands of employees when there is cut in salary due to ongoing crisis. Just to clarify, the implication which we are discussing shall apply whenever there is a pay cut. It nowhere means that these provisions will be applicable only if the pay cut is because of COVID-19. So now the first question which must be coming in your mind, what exactly do we mean by the term pay cut? So guys, the pay cut is a situation where the amount deducted by the employer is not payable at all. That is, employee has lost the right to receive this amount. So two possible situations might happen in this case. The first one is when the employer revises the CTC and the same is reflected in your salary slip. And the other situation is that the cut might not be reflected in your salary slip since the CTC has not been revised. So if the CTC of an employee undergoes any revision, that is cut or hike, then such revision should be reflected in the employee's salary slip as well. Thus it means that the components of the salary such as basic, HRA, special allowances should be revised correspondingly. Considering the fact that income from salary is taxable on due basis, it will be taxable in the hands of employees whether received or not. Hence, if CTC is not adjusted and the components of your salary are not revised accordingly, then the income tax will consider your salary slips for the purpose of computing your taxable salary and tax thereon. Further, we all are aware of the fact that companies are required to deduct TDS on salary at the time of payment only. Therefore, in case your employer has cut your salary and not revised your CTC, then you might have to pay tax on your entire salary, even if the same is not received by you. So you have to make sure that you don't face such situation wherein you are not receiving salary and paying taxes thereon, as this is going to be a double hit on you. To avoid such circumstances, some points should be strictly taken care of. So if your salary has been cut, please insist on a written communication from your employer and ensure that cut gets reflected in the components of your salary as well. It is advisable that you get clarification from your employer as to whether the deduction from salary is a pay cut or merely a deferral of payment, because the treatment in both the cases will be different. Employees should also ensure that the reduced salary is concretely evidenced through a revision in the appointment letter and payslip. Guys, please appreciate that taxes on salary are very much dependent on how the pay cut is administered and the documentation around it. And ultimately at year end, your taxability will be determined by TDS certificate, that is Form 16 issued by employer. So make sure that it correctly reports your salary for the year end consideration. The Finance Act 2020 has introduced an alternative tax regime for individual taxpayers from the financial year 2021 onwards. So Dipen shall be covering it in detail in the later part of today's webinar. There are multiple factors which you need to consider while deciding which tax regime to opt for. And CBDT has issued a circular on 13 April 2020, wherein it has been provided that taxpayers intending to opt for new regime may convey their intention to employer, and the employer, after receipt of such intimation from employee, shall compute total income and deduct tax as per provisions of section 115 BAC. And in the absence of any such intimation, employer shall calculate TDS without considering the provisions of section 115C, that is, as per normal provisions of the Income Tax Act. So why we have brought these points in between is that there might be a possibility that an assessee who has conveyed to employer to opt for old tax regime would like to switch to new tax regime considering his revised annual income because of pay cuts and the amount he can spare for making tax saving investments. New tax regime provides for lower tax rates with 7 tax slabs, and assessee is not required to make investments in order to save tax. It will leave more money at his disposal. But the challenge here is that the intimation made to employer cannot be changed by employee during the year. Hence, employer will continue to deduct TDS as per the intimation submitted to him. However, the employee may opt for different option at the time of his income tax return filing. And if there is any excess or shortfall in deduction of tax because of change in option, that can be claimed as refund or paid respectively at the time of filing ITR. Now let's move to the tax implications in the hands of employees due to deferment of salary. Deferral is nothing but a shift in payment of some portion of salary. This implies that a component of salary is withheld by employer and shall be paid on a later date. Many companies are not doing pay cuts but delaying certain part of salary because of liquidity issues. And in case your salary has just been deferred and will be received by you after a period of time, it will be included in your taxable salary for the period, irrespective of the fact that the same is received after some time. And the deferment will not anyway affect your taxability as the salary is still due and will be received later on. The issue which will arise here is that TDS will not be deducted by your employer as the same is deductible at the time of payment of salary. Now, if your salary is deferred, the employer is liable to deduct TDS on salary at the time of payment, but it will remain taxable in your hands on due basis. Now, since your salary that is due is taxable for the employee even if it is not paid, and the employer has not paid the TDS thereon, then technically it becomes the employee's responsibility to pay advance tax on that. Therefore, if no TDS is deducted and you delay the advance tax payments, then you will be need to bear the interest cost under section 234B and C. Deferral won't attract any revision in the contractual terms agreed between the employer and employee. The employee only needs to take care on the basis of calculation so that he does not end up becoming a defaulter due to non-payment of advance taxes once the provisions are applicable in his case. Let's now take up the next issue, which deals with the treatment of allowances due to prevailing lockdown situation in the country. So the allowances are just additional components of salary which are given regularly to the employees to meet expenditure for some particular purpose. For example, house rent allowance, dearness allowance, transport allowance. Allowances are generally fixed irrespective of actual expenditure and are taxable. However, some exemptions are allowed under Income Tax Act. Allowances are taxable unless specifically exempted. Certain allowances such as conveyance allowance and per diems are exempt from tax to the extent spent by the employee. If the allowances are not spent, they are taxable. The current situation is such that the employees are forced to work from home and it is not possible for them to spend these allowances for the designated purposes. Given this situation, the allowances will attract tax. Thus, depending on the specific provisions providing taxability and considering the exemptions laid down, the allowances will be taxable in the hands of employee. Let's take up the next point, which is taxability of amount withdrawn from tax saving schemes. I have seen that many people these days are making withdrawals from saving schemes to meet their day-to-day expenses. This is on account of the cash flow issues faced by them due to job losses. Some people are making withdrawals because of rumors that their money is not safe with the banks and post office due to this corona situation in the country. But please note that such withdrawals may be necessary, but one needs to be mindful of tax implications as it may lead to additional tax cost. And the government has allowed partial withdrawal in the light of COVID-19 outbreak from EPF account. So now EPFO subscribers can withdraw 75% of their savings or up to a maximum of 3 months basic pay and DNS allowance from their PF account, whichever is lower. And for this purpose, no certificate or documents are to be submitted by member or his employer for availing the benefit. The amount withdrawn by you due to outbreak of the pandemic is non-refundable. Therefore, you are not required to refund the withdrawn amount back into your EPF account. But the government has not relaxed conditions of withdrawals from other savings schemes. So premature withdrawal from other schemes may attract some penal charges and have tax implications as well. And there are different set of rules of withdrawal for different schemes. So before making any withdrawal, you should consider the tax implications on it. And due to shortage of time, it won't be possible to explain rules for all the saving scheme. So you may visit taxman.com to understand the rules of tax saving schemes and make an informed decision before making any such withdrawal. The government has also relaxed rules of making PF contribution. Recently, EPFO waived off the penal damages for delay during deposit during the lockdown period. The two other major changes are relief to low wage earning EPF members and reduced contribution from 12% to 10%. These both we have covered in the coming slides. So on 26th March 2020, the government announced PM Garib Kalyan Yojana for helping the poor to fight coronavirus pandemic. And the central government had said that it will contribute 24% of salary, that is 12% employer share and 12% employee share. So it is applicable for the employees working in firms having up to 100 workers, of which 90% withdraw not more than rupees 15,000 per month salary. And earlier this contribution was announced for 3 months, that is March to May. But at the time of announcing Atmanirbhar Bharat package, the finance minister extended this support for another 3 months, that is June, July and August as well. The reduction in EPF contribution was announced by Finance Minister Nirmala Sitharaman as a part of Atmanirbhar Bharat package to provide some relief to employers and also to increase the take-home pay of the employees. The statutory rate of EPF contribution of both employer and employees has been reduced to 10% of basic wages and DNS allowance from existing rate of 12%. And this shall increase the take-home pay of employees and relieve people's financial burden to some extent. But at the same time, the employees need to recalculate their tax savings so that they need not pay extra taxes because of increased in-hand salary. This benefit of reduced rate of contribution from 12% to 10% is applicable for wage months of May, June and July. The reduced rate is not applicable to the establishments like central and state public sector enterprise and the establishments controlled by the central government or state government. Further, the reduced rate is also not applicable to the establishment eligible for Pradhan Mantri Garib Kalyan Yojana, since the entire benefit for those establishments, that is 24% of monthly wages, is being contributed by the central government. With this, we have come to an end of discussion in relation to impact of COVID-19 on salary clerk. So in case you have any queries, I'll be happy to answer it in the chat box. With this, I would now request Dipen to please take up part 2, that is new tax regime under section 115 BSE.
Thank you, Taram, for very interesting presentation you given on impact of COVID-19 on employees. Friends, now let's discuss about the new tax regime under section 115 BAC. Section 115 BAC is inserted under Income Tax Act by Finance Act 2020. It basically provides for a new tax regime which shall be applicable only to an individual or HUF. When I talk about individual or HUF, they can be resident or non-resident. So the eligibility of assessee to opt for this regime is not dependent upon his residential status. Even a non-resident person can opt for this regime. Further, an individual can be of any age. So even a senior citizen or super senior citizen can opt for this regime. This regime is applicable from assessment year 21-22 onwards. So the eligible assessee, that is individual or HUF, can opt for this regime from assessment year 21-22 onwards only. We are calling this regime as alternative or new tax regime because under this regime, the government has provided an altogether new income tax slab rates. Further, this scheme is optional for the assessees. Thus, an individual or HUF has the option either to pay tax as per the new regime or continue with the existing one, that is the income tax slab rates provided under the first schedule of the Finance Act. In the next two slides, we will discuss about the tax rates provided under the new regime and then compare them with existing income tax slab rates. So first, let's see the tax rates provided under the new regime. Before discussing about the tax rates, let me here clarify that as this new regime does not make any difference between the residential status and the age of the assessee, therefore, the tax rates provided under this regime shall be same for resident, non-resident, senior citizen or super senior citizen. As you can see, under the new regime, the maximum exemption limit is 2,50,000. So there is no change in the maximum exemption limit. Maximum exemption limit is same. So no tax shall be payable by the assessee if his normal income is up to rupees 2,50,000. Here you please note that I am using the word normal income because slab rates do not apply to incomes which are chargeable to tax at special rates. Thus, if total income of assessee includes any income which is chargeable to tax at special tax rates, then such income shall be continued to be taxed as per the normal provisions of the Act. I have mentioned this point in the next slide. So the basic exemption limit under new regime is 2,50,000 and it will be same for resident, non-resident, senior citizen and super senior citizen. Now, if your income exceeds rupees 2,50,000, then on every additional 2,50,000, the tax rate is increased by 5%. As you can see in this table, if your income is between 2,50,000 to 5 lakh, then tax rate is 5%, and thereafter it is increasing by 5% on every additional income of rupees 2,50,000. But the highest slab rate is same, that is 30%. So under the old regime as well as under the new regime, the highest slab rate is not changed. It is same. It is 30%. So now if your income is above rupees 15 lakh, under the new regime, you will have to pay tax on 30% on that income exceeding 15 lakh. And under the old regime, there was 30% slab rate starts from whenever your income exceeds 10 lakh. So let's compare the tax rates of new regime with the old existing one. If I compare the tax rates provided under new regime with existing one, we will find that the exemption limit is still same as I already discussed. But the tax rates have been reduced under new regime for income ranging between 5 lakh to 15 lakh. As you can see, for income from rupees 2,50,000 to 5 lakh, the tax rate is same, that is 5%. But for income ranging between 5 lakh to 15 lakh, the tax rate is substantially reduced. Under old regime, if you have income between 5 lakh to 7.5 lakh, the tax rate is 20%, but under the new regime, it is 10%. It is to be noted that the rate of surcharge, health and education cess, and tax rates in respect of special income shall remain same. Further, rebate under Section 87A shall be available for both under the new and old tax regime. So, if your income is up to rupees 5 lakh and you are a resident individual, then you can claim rebate under Section 87A for up to rupees 12,500. The finance minister, while introducing this new tax regime, said in her budget speech that tax burden on a person earning rupees 50 lakh shall be reduced by rupees 78,000. And if we compare the slab rates provided under the new regime and old regime, she seems to be right. But wait, there is a catch. If an assessee opts for Section 115 BAC, that is new tax regime, he has to forego many deduction or exemptions while computing his total income. Therefore, if any person is availing exemption or deduction in the current regime, then he might not be able to save much tax. Rather, he may end up paying more tax under the new regime if the amount of deduction or exemption he is availing under the current regime is substantial. How it may happen, we will discuss it later. So if you want to compute tax on your income as per old regime and new regime, I would suggest you to refer income and tax calculator available at taxman.com. It is quite easy to use and it will give you the accurate results. So now let's come to the next slide. Deduction or exemptions not available under the new regime. As I said earlier, a person opting for new tax regime has to forego many exemptions or deductions while computing his total income. So what are such deduction or exemption? We will discuss those headwise. So let's come to first salary. So while computing income under the head salary, the following exemption or deductions shall not be available to assessee who are opting for new regime, that is Section 115 BAC. Leave travel allowance, house rent allowance, official allowances, even official allowances shall not be exempt except conveyance, traveling and daily allowance. CBDT will come out with rules in this respect because the rules have not been changed yet. So CBDT will surely come out with that. Personal allowance, no exemption shall be available in respect of personal allowances like children education allowance, etc. However, exemption of up to rupees 32,000 per month shall be available in respect of transport allowance granted to Divyang employees. Free food or vouchers. As free food or vouchers is treated as perquisites, no deduction of up to rupees 50 per day per meal shall be allowed while computing that perquisite value if any free food or vouchers is provided by an employer to his employee. Allowance to MPs, MLAs are exempt under Section 1017. So this exemption shall also not be available. Even a standard deduction of rupees 50,000 shall not be available if you are opting for the new regime. Deduction for entertainment allowance, deduction for professional tax. So any deduction which is mentioned under Section 16 of the Act shall not be available to assessees who are opting for the new regime. Now, coming to the next slide, house property. The incentives which are blocked in respect of house property are as under: interest on loan taken in respect of self-occupied house property. No deduction under Section 24B shall be allowed for interest on loan taken in respect of self-occupied house property or property which is lying vacant due to employment or business profession of assessee at any other place. So if the annual value of the property is considered as nil as per Section 23, then you are whatever the interest on loan you are paying in respect of that property, you will not be able to claim deduction in respect thereof under section 24B. Further, if there is a carry forward loss under the head house property, which is attributable to such properties, that is self-occupied house property, then assessee will not be able to claim such loss. The current year loss as well as brought forward loss relating to self-occupied property shall not be allowed while computing total income. Furthermore, subsection 3 of section 115 BAC provides that such loss shall be deemed to have been given full effect to while computing total income, and no further deduction for such loss shall be allowed for any subsequent year. So what that means? It means, thus, once you opt for this new regime, you will not be able to carry forward such loss, and same shall lapse. Please note my point. The same shall lapse. So if you have any brought forward loss relating to self-occupied property, then I would suggest to do proper cost benefit analysis before opting for this new regime. Further, intra-head set-off of house property loss shall not be allowed. Under the new regime, it has been provided that the loss under the head income from house property cannot be set off against income under any heads. So you will not be allowed to set off the house property loss with any other income, but you can set off, suppose if you have to let out property, there is loss under one head, one property, and there is income from another, then you can set off the loss of one from an income of another. But if this loss still remains, then you will not be allowed to set off that loss from the other heads of income. As you must have aware, section 71 allows set off of house property loss against income under any other head only to the extent of rupees 2 lakh. However, if assessee opts for this regime, then it would not be permissible to set off the house property loss. Thus, the entire loss would be carry forward and set off. This view is supported by the memorandum explaining the amendments made by Finance Bill 2020 as well. The memorandum states that loss under the head income from house property from rented house shall not be allowed to be set off under any other head and would be allowed to be carry forward as per extant law, that means existing law. Thus, if you have any loss from a rented house, then you can adjust from such loss from an income of another rented house. However, if such loss still remains same, then you will not be allowed to set off from other heads. So you have to carry forward and set off in subsequent years. So this was all about the incentives which are blocked relating to house property. Let's move to the next slide. Business or profession. While computing the business or profession, following deduction shall not be allowed. Additional depreciation shall not be allowed. Investment allowance in respect of new plant and machinery in notified backward areas shall not be allowed. Deduction in respect of deposit in tea, coffee or rubber development account by assessee carrying on business of growing and manufacturing of tea, coffee or rubber. No deduction shall be allowed in respect thereof. Deduction in respect of deposit in site restoration fund by assessee carrying on business of prospecting, extraction or production of petroleum or natural gas shall not be allowed. Deduction in respect of payments to research association, university, college, national laboratory, etc. That is the deduction which are allowed under section 35 will not be allowed under the new regime. Investment linked deduction allowed to specified businesses as specified under section 35 AD. No deduction shall be allowed in respect of such businesses. Expenditure on agriculture extension project shall not be allowed. Further, if there is a carry forward loss under the head business or profession which is attributable to aforesaid deduction, that is the deduction which I have mentioned above, then assessee cannot be able to claim such loss. One more thing which is to be noted here is that depreciation, the normal depreciation. I'm not talking about here the additional depreciation, because additional depreciation is by default not permissible if you are opting for the new regime. I'm talking about the normal depreciation. The normal depreciation will also be computed in a notified manner. So there will be a different mechanism for computing the depreciation. So accordingly, CBDT may have to amend Rule 5 on new Appendix 1. Note, no deduction under Chapter 6A. No deduction under Chapter 6A, that is Section 80C to 80U, shall be allowed, except this only three: employer's contribution to NPS, deduction for additional employee cost, deduction in respect of income of a unit located in IFSC, International Financial Service Center. Thus, if I talk about from the perspective of an employee, the only deduction which is allowed is employer's contribution to NPS. No other deduction under Chapter 6A shall be allowed, like deduction for contribution to PF, saving schemes like PPF, NSC, medical insurance, ATD, educational loan. No deduction under Chapter 6A shall be allowed. So you can only claim, so if you are an employee, you can only claim deduction for the employer's, not employer's contribution to NPS. So even if you are contributing anything to NPS, then you will not be able to claim deduction. Only employer's contribution to NPS is allowed. Moving to the next slide. So apart from the deduction or exemption which I have already discussed in the previous slides, following exemption or deduction shall not be allowed to the assessee opting for Section 115 BAC. Exemption in respect of minors' income clubbed in the hands of parents. The 1,500 reduction, that is exemption that is allowed in case of minors' income. Deduction from family pension. Deduction in respect of income of a unit located in SEZ, or any other exemption or deduction for allowance or perquisite allowed under any other law for the timing in force. So it is talking about if there are any exemption or in respect of allowance or perquisite that is provided under any other act except Income Tax Act, then no such deduction or exemption shall be allowed. So the provisions relating to AMT has also been amended. So the person opting for Section 115 BAC shall not be liable to pay AMT. Further, he shall not be able to utilize the unutilized amount of AMT credit. So I would suggest, if you have substantial amount of AMT credit which is lying unutilized, then I would recommend to opt for the new regime only after utilizing that credit, because once you opt for the new regime, then AMT credit would lapse for forever. You will not be allowed to claim that credit in subsequent years also. So, as I already discussed, the government, with a step towards simplification of tax and bringing more people into tax bracket, came up with an altogether new tax regime, which did reduce the personal tax rates for individual and HUF. However, if you are opting for the new regime, then you would not be entitled for various deduction and exemptions which are widely claimed by many people, as we already discussed. Like you will not be entitled for even deduction under Section 80C, ATD. Like you won't be able to claim the loss from self-occupied house property. So it is very important for a person to consider his income and the deduction he usually claims to decide whether he should opt for the new regime or not. So in this slide, we have identified some break-even points which can a person dis, which can a person use to decide whether he should go for the new regime or not. Break-even point is the point where tax under old and new regime would be same. It is computed on the basis of amount of income of assessee and incentives that he has to forego. That is the block incentives, which we talked earlier on opting for the new regime. So if your income is rupees 5 lakh, then tax under both old and new regime will be nil due to rebate provided under section 87A. Thus, we will not be required to check whether check the amount of blocked incentives in this case. However, if your income is rupees 7,50,000, that tax under old and new regime would come out to be same. That is, as I mentioned in table 39,000. If the amount of blocked incentive is rupees 1,25,000. Thus, if the actual blocked incentive is in your case is more than 1,25,000, then you should opt for the old tax regime. Otherwise, you may opt for the new regime. So, in this slide, I have considered some incomes. So, for the complete break-even point table, you can refer our Taxman's direct tax ready reckoner, in which a complete break-even table has been given. So, coming to the next slide. As we have already discussed about the tax rates and the implication of opting for new tax regime, now we will see if a person intends to opt for new regime, how can he opt for the same? And after opting for the new regime, if he wants to opt out from that scheme in subsequent years, whether he can do that or not. So how a person can opt for the new regime? Firstly, the year. The new tax regime is applicable from assessment year 21-22 onwards only. Therefore, an individual or HUF can opt for the new regime from assessment year 21-22 onwards. Time limit. The time limit for exercising the option it has been provided under the Act that if assessee having income from business or profession, options should be exercised on or before the due date of filing of return specified under section 139(1). So the option should be exercised before the filing of original return. And if you have any income from business or profession, if you once opted for that scheme, it shall be valid for all subsequent years. Whereas if assessee does not have any income from business or profession, options should be exercised along with return of income to be furnished under section 139. It is also talking about the original return. Further, assessee can exercise the option on year-to-year basis. It is not like the one we discussed earlier. In case you have any business income, business or profession income, then you once exercise it, which it will be valid for all subsequent years. But if you do not have any income from business, then you can opt for the regime on year-to-year basis. Here, two aspects are very important to be discussed. If we talk about assessing having income from business or profession, it specifically provides that options should be exercised on or before the due date of furnishing of original return. Thus, if the option is exercised after the expiry of the due date of original return, the assessee cannot exercise the option for that assessment year. However, it is not necessary that the return should also be filed on or before the due date. So, if you are having any income from business or profession, so you should opt for the regime before the due date of furnishing of original return. But it is not necessary that return should be filed, which means It is sufficient if the option is exercised before such date, it means original date. That in case of belated return or revised return, the assessee can avail the benefit of this section provided the option is exercised. Suppose if you have filed the form for opting for the new regime before the, let's say I take the example 31st July, but you have not filed the return before the 31st July. So you can still be able to claim the benefit of the new regime whenever you file the return, but the option should have been exercised before the filing, before the due date of original return. That is before 31st July. Whereas if we talk about the assessee who does not have any income from business or profession, the option should be exercised along with return of income to be furnished under section 139(1). So the word which has been used under the act is along with the return of income. So if you do not have any income from business or profession, so you must have exercised the option at the time of filing of original return only. You cannot claim it thereafter. So even in belated or revised return, you will not be able to opt for it. The manner of exercising of option, the manner has not been prescribed yet. So the CBDT will notify rules and form for this purpose. So coming to the next slide now. Withdrawal from the new tax regime. Suppose if I have opted for the new regime, so can I opt out from it, withdraw from it from subsequent years? Yes, you can opt out from it, but different provisions have been prescribed for in assessing having income from business or profession, or assessee who do not have any such income. Where an assessee having income from business or profession, he can withdraw the option only once. He can withdraw the option only once for the previous year, other than the year in which the option exercised. Suppose if in year 1 you have exercised the option, you will not be able to opt from that option in year 1, but an one-time opportunity has been provided to assessing having income from business or profession to opt out of this scheme. So if you have opted, then you can opt out from in next year or in subsequent year, whichever in year you wish. But here it is to be noted that the assessee once exists from the scheme, he will not be able to enter again. So if you are having any income from business or profession and you have opted out from the scheme, then you will not be able to enter again unless you ceases to be in business or profession. So you should have other than the income from business or profession, then only you will be able to come again and opt for the new regime. As far as assessee who does not have any income from business profession, he can, as we discussed, he can opt for the new regime on year-to-year basis. Thus, he can withdraw from the new regime from any previous year, other than in year which the option is exercised. Suppose if you have opted for year 1, so you will not be able to opt out for the year 1, but you can opt out for year 2, and then again come in year 3 and opt for this scheme. Talking about the consequences in case of breach of condition. As I said, if you opt for the 115 BAC, then you will not be allowed to claim certain exemptions or deductions. So you have to compute your total income without allowing such deductions or exemptions. So if you breach that conditions, then following consequences shall occur. If you have any business if you does not have any income from business or profession, option shall become invalid for only that relevant previous year. So suppose if you have not computed your income, you have claimed any exemption which is prohibited under section 115 BAC, then option shall be invalid for that relevant year only if you do not have any income from business or profession. But this is not the case with the assessee who is having any income from business or profession. In his case, the option shall become invalid for relevant previous year as well as all subsequent years. So once you fail to meet the conditions, then in upcoming years also you will not be able to opt for it. And the consequences will be, once the option becomes invalid, the total income of the assessee and tax thereon for relevant previous year or subsequent previous assessment years, the income shall be computed as per the normal provisions of the act. Means he is not opting for the, we will consider he is not opting for the new regime. So normal provisions of the act will apply. However, the deduction or carry forward losses and other additional depreciation, actually the block incentives which we are talking, will be lapsed and will not be revived again. Now coming to the last slide, intimation to employer for purpose of TDS. As an employee can opt for the new regime at the time of filing of return of income, but the TDS on salary is required to be deducted by the employer in advance, because TDS is deducted at the time of payment of salary and you file your return after the completion of the relevant year. So in this regard, it has been clarified by the CBDT that an employee intends to opt for new tax regime, he may intimate the same to his employer. So it is not mandatory for an employee to intimate to his employer if he intends to opt for the new regime. He may or he may not. So it is not mandatory for the employee. But if he intimate his employer of his intention, then upon such intimation, it will be mandatory for an employer to compute total income of the employee and deduct tax thereon in accordance with the provisions of section 115 PAC. So if I have intimated my employer that I want to opt for the new regime, then it is mandatory. It is mandatory for an employer to deduct tax as per section, to compute income and deduct tax as per section 115 BAC. However, if no such information is given by the employee, then total income and tax thereon shall be computed as per the normal provisions by the employer. Intimation may be given by employee every year. So if you do not have any income from business profession, you can give the intimation to your employee every year. As you can opt or not opt for new regime, you have to decide in which year you have to opt, you want to opt for, or in which year you don't want. But if an employee, suppose, is having any income from business or profession is also, then he cannot deviate from the option to pay tax under the new regime in subsequent years. So once you have intimated the employer that I want to opt for the new regime, then and you having any income from business or profession also, then you will not be able to deviate from that scheme in subsequent years also. Further, it has been clarified that option at the time of filing of return of income by employer could be different from the intimation made by the employer for that previous year. So suppose if you have intimated to your employer that you want to claim the benefit of new regime, but suddenly you think, no, it is not beneficial for me. So at the time of filing of return, you can opt out, you can choose the different regime. So it is up to you. So that was all about the new taxation regime under section 115 BAC. I thank you all for participating in this webinar.
Thank you, Dipen. Thank you for your time. Thank you, Dipen and Tarun. It was really wonderful session. We had a lot of people queries and our team has been answering it. So guys, Taxman has just announced the release of Finance Act 2020 publications that are available on Taxman's online store. Books ordered from Taxman store now come with actually alcohol-based sanitizing wipes to ensure your safety. So please go through our online products. Also, we have shared you the PPT handout. You can download it from your file section. I hope all of you are able to download it now. Perfect. So thank you all for listening carefully to our session. Thank you, Dipen and Tarun, once again. Any questions? Dipen, anything you want to add?
No, thanks, Vinay. Is there any query left, I can answer. I think most of the queries have already been answered by our identity team.
Pretty well in the charts. Team has been handling it, Naveen and
okay.
team. So thank you very much. Thank you, everyone. Hope all of you have downloaded the PPT. You'll also get a recording of this webinar today evening if you want to kind of watch it or share it also. Okay, perfect. So hope all of you have downloaded. So we'll just keep this page active for another 5 minutes so that you can download that file, and we are concluding the webinar with this. Thanks everyone. Stay
Thanks.
safe.